Hi, let's get started right away. I am first making you revise the F9 Wacc, and then we move on to P4 Wacc. The F9 Wacc, um, first of all, we need to know what is Wacc. Wacc is a cost of capital of a company which is raising finance through different sources. Now, a company usually raises finance through four sources. That are the main four sources. First is equity. The cost of raising finance through equity is cost of equity, that is KE. Debt. The cost of raising loan notes is interest, that is cost of debt or KD. The cost of raising finance through bank loans is again interest amount, that is cost of bank or KB. And preference shares, the cost of raising finance through preference shares are the dividends or the interest amounts, that is cost of preference shares KP. Now, in order to compute KE, I am sure you remember that there were two models. One was DVM, dividend valuation model, and the other was CAPM, capital asset pricing model. DVM or dividend valuation model is used to compute share price, and the formula is P naught is equal to D1 over KE minus G, where if you want to compute the cost of equity and not the share price, you need to rearrange the formula and put it like KE is equals to D1 over P naught plus G, where D1 is next year's dividend. Question often gives you current year's dividend. So what you have to do is that you have to add the growth rate to current year's dividend in order to compute next year's dividend. KE is the cost of equity, G is the growth rate, and P naught is the current share price. Now there are two kinds of P naught or share prices that are given in the question. One is cum dividend, that is including the dividend component, and the other is ex dividend, excluding the dividend component. Here's a short example. It says current share price is $10, dividend per share is $0.2, growth rate is 10%, requirement is KE under DVM. You can see how I have computed KE. I'm not explaining this because then again it is a revision of F9's Wacc, and I am confident that I guess you do remember F9 Wacc. Okay, if growth is missing, then Gordon's retention model shall be used, or past dividend model will be used. Gordon's retention model has a formula of growth is equals to B into R, where B is the retention ratio, R is the return on investment or return on equity. Now, retention ratio is basically the ratio of the amount of profits that you have retained as a company. How is it computed? Retention ratio is equals to 1 minus payout ratio. If you are writing the answers in decimal, then 1 minus payout ratio. And if you are writing the answer in percentages, then 100 minus payout ratio percentage. Okay, that is going to give you the retention ratio in percentages. How is payout ratio computed? Dividend per share over EPS, and the return on equity or the return on asset is always given in the question. Past dividend model formula is G is equals to latest dividend over earliest dividend to the power 1 over n minus 1, where n is the number of times there is a chance of growth. Now in this case, since we have a list from 2016 to 2020, we are going to write n as 1, 2, 3 and 4. Why? Because 2016 to 2017 there is one chance of growth. Then from 2017 to 2018 there's a second chance of growth. Then 2018 to 2019 there's a third chance of growth. And from 2019 to 2020 there's a fourth chance of growth. Okay. Here are the examples. I did not compute the KE, I just computed the growth rate for both of the examples so that you know how to compute the growth rate, or you can recall it. Model number 2 is the CAPM, that is the capital asset pricing model, which we consider is a better model to compute cost of equity than DVM. Why? Because it incorporates risk. What are the kinds of risks that it incorporates? There are two kinds of risks: systematic risk and unsystematic risk. Systematic risk is one which arises when the state of an economy is so worsened that you cannot avoid losses, or you cannot diversify your risk by investing in some other property, or let's say some other business sector. Okay. However, unsystematic risk is one which can be avoided by diversifying your investments to different sectors. Portfolio theory says never should you keep all your investments in one place. Why? Because if you will be making a loss in one of them, then there is a chance that you will be making a loss for a large amount of money. Okay, that is, if you have all your investments at one place and that fund is making a loss, then all of your money will be lost. Okay. How CAPM computes KE? KE is equals to rate of government bonds plus risk premium, where rate of government bonds is also called the risk-free return, and risk premium is the bracket RM minus RF. This bracket is called risk premium. If the examiner has given you only risk premium, then you do not need RM. Okay, you can just write the percentage over here, and you'll be able to solve the question. Then you do not have to put RM and RF in that case. Then we have beta equity, which is a measure of risk that tells us that as compared to the market, how much riskier is our company. Here is one example where I have solved it to show you how do I compute KE under CAPM. Now, if beta equity is missing, what needs to be done then? In case if beta equity is missing, then you are going to use the beta asset that will be given in the question. Beta debt is often risk free, but if it is not risk free, then the question will mention it, and if it is risk free, then also the question will mention it. So if the debts are risk free, beta debt will be 0, and if debts are not risk free, then whatever the beta debt is given, you will use that. The formula is beta asset is equals to beta equity into equity over E plus D 1 minus T, where E and the D is the market value of equity and market value of debt, plus BD, where beta debt is the BD, into D 1 minus T over E plus D 1 minus T. Now here's an example. Share capital is $10,000, $0.5 per share, 15% debentures are given at a value of $6,000. Other information is given. Asset beta is 1.3, taxes 30%, current share price is $2 per share. Debts are traded in the market at 110 over $100. And it is risk free. Find beta equity. Now you have the beta asset, that is 1.3. Beta equity needs to be found out. Now in case when the beta equity is found out, what you need to do is that you need to compute the market value of equity first, you need to compute the market value of debt first. So how are you going to compute the market value of equity and market value of debt? Over here you can see the working in that blue box. 10,000 over 5,000 gives us 20,000 shares into $2 per share, because that was the market value. So $40,000 is the market value of equity. 6,000 into 110 over 100 was the market value of debt. In that way I computed the beta equity after putting each and everything in the formula. Now, in case of KE under CAPM, you already know that we use the diversification scenario, that is ungearing and regearing. In ungearing, you use the proxy data. You can ignore the screen for now. I'm just explaining it to you verbally, and then we'll move on to the P4 Wacc in the next video. So in the ungearing case, you are going to compute the Wacc using the proxy data, and in the regearing scenario you are going to use your own company data, and I'll explain it in a lot more detail in the next video.